Please stay tuned after the conclusion of the podcast for additional important information. Hey everybody, welcome to another edition of Accrued Interest, PIMCO's podcast dedicated to serving financial advisors and their clients. Really timely discussion today with Greg Sharenow. Greg is a managing director in our Newport Beach office. He looks after our commodity investing business, which includes a number of products on the traditional side, on the hedge fund side. He takes a really expansive global view of his sector, which of course draws in and draws on a lot of PIMCO's macro expertise and our views about government policy around the world, about the shape of underlying economies, the direction of rates, and all the markets that have influence over what commodities themselves do. It's timely on a number of fronts. We're going to be talking about gold today, which I think if it's not every headline on Bloomberg this morning, it's most of them. And we'll be talking about energy and some of the changes to energy demand brought on by AI and some of the difficulties in serving that demand due to energy infrastructure in the U.S. and globally. It's going to be a little confusing having two Gregs on the podcast. This is a first for us. But anyways, Mr. Sharenow, welcome to the pod, and thanks for joining us.
Thanks, Greg. It's really nice to be on with you. I look forward to the conversation.
Yeah, great. And then also, as always, we have one of our account managers in from the field to help us with today's podcast. Brady Morrison joins us. He's sitting in the studio with Greg in Newport Beach, but when he's not doing that, he covers Montana and Idaho for us. And before we started recording here, we were debating sort of what native insight that gives him to commodity markets, being from, I guess, some farm country, out there in Montana and Idaho.
That's right, absolutely. Regions with deep ties to agriculture, livestock, you name it. So excited to be here.
Probably a few AI billionaires hanging around Idaho these days as
Absolutely.
well, right? Okay, good. Well, anyways, Greg, why don't I gave you a little bit of an intro on the way in, but maybe just to set the stage here, you can help our listeners understand kind of where you come from and how you got to PIMCO, what you've done in your career, and then give us a little bit of a sense of what you're overseeing these days at PIMCO.
Sure. I started off my career as a quantitative research analyst at Goldman Sachs, where I focused on portfolio construction theory.
Was that as exciting as it sounds?
If you like a lot of quiet, thoughtful time, yes. But if you're interested in the dynamic markets of commodities, which ultimately attracted me, it was a very different environment than being a economist for 5 years covering the commodity markets itself. And since 2005, I've been an investor in the commodity markets, whether it be at hedge funds or a merchant fund, as well as being at PIMCO now, so for 14 years. So I've been investing in energy primarily and commodities more broadly for almost 20 years at this point, or actually over 20 years.
How do you think markets have evolved kind of since your early days? It sounds, when you say the quantitative research group back at Goldman, how have markets evolved, kind of since that time? And what made you focus on becoming an investor as opposed to somebody observing and maybe taking a more academic interest in these markets?
I think where the rubber hits the road was sort of where attracted me to the investing side, where at some point you have to see if your views actually, have information content and do you have an edge. And it's been a race over the last 20 years to continually evolve and improve that edge because, your initial part of the question was how are things changed? Well, at one point you could have real information edge on data in lots of sectors in the commodity markets by being advanced, using satellite imagery first, aggregating all the public information in a quantitative way. And those things have become commoditized over time, things we would spend multiple headcount people plus a lot of resources on. You can now get on your Bloomberg terminal for free or for a modest amount of money have a third-party provider. So that's led to an evolution of investing styles, become much more there's much more opportunities for systematic investing and quantitatively driven investing in commodities that we've taken advantage of over the last 14 years since I've been at PIMCO, but certainly over the 20 years of me doing this, it's become, in some respects, more professionalized in the way in which we have to approach it. And a lot of leveraging off of what PIMCO does in the fixed income markets and understanding how to capture, risk premiums has been another focus to try to create a new edge, because just being faster at having the information is much harder now. And then the other part that's really changed is that China, as it has grown relative to when I started in the late 90s, their share of all the commodity markets have exploded. But also that means there's a little bit of a black box there.
Mm-hmm.
Changes in their purchasing patterns could have short-term meaningful implications to how the commodity markets clear. And some of that is hard to predict because of the nature of the command and control, largely, not entirely command and control, but a lot of that in the commodities. We see that bearing out in the trade wars that we are having now between where, they're not buying soybeans, which is if you're not talking about gold on the cover of all the newspapers,
Right.
It's been soybeans for political
right.
reasons. And I think that has added a wrinkle that has created greater challenges in analytics, but also opportunities, because ultimately the economics of the markets need to clear them.
How does this fit? I think a lot of listeners and financial advisors will be very familiar with PIMCO's fixed income, but maybe less so with what we do in commodities. So maybe just give us a sense of the scope of what we do, and then maybe even more importantly, how it fits into the overall investment process at PIMCO, and how well integrated it is within some of the other things that we do.
Yeah, sure. So we manage about 15 to 16 billion in commodity-specific mandates. And then I also manage our multi-asset inflation product, where we invest in a variety of inflation-sensitive products, which kind of directly links me to a lot of other businesses, whether it be our TIPS business, which part of our mutual fund universe actually invests the collateral in TIPS. So we're deeply integrated with our treasury and inflation-linked bond desk as well. But when you break it down, the benefit of being in a place like PIMCO for me as an investor, in addition to, frankly, helping me see new ways of investing in commodities. I think my career was very much extended by being in a place which really focused on structural opportunities, which many commodity investors inherently don't do, because they're trying to get the next move right and not thinking about how would a portfolio work over 3 or 5 years if I understand how the carry is going to drive a commodity trade. That's beyond their investment horizon.
Mm-hmm.
But the other area where it really is benefits me, and I think I benefit the firm, is that having analysts who cover global and portfolio managers that trade global, credits, for example, or equities, is that, if I want to understand what's going on with the oil distribution system in Mexico, because that's going to matter to Gulf Coast refined product demand, because we're a big source into Mexico. It's nice to be able to talk to the guys who cover that, or China economist. And also when you're trying to process geopolitics, I need to crowdsource. The reality is that while I can contribute to how PIMCO is thinking about geopolitical risk, whether it be in Israel and Iran, whether it be Russia and Ukraine, there's only so many things you can be certain of.
Mm-hmm.
And having people to really hash out the ideas is critical for me to understand what might happen, and might be an impulse for commodities.
Well, maybe we'll jump into it. We referenced it at the outset here, and it's a topic I know it's on the minds of a lot of advisors out there, kind of given the headlines. And no, it's not soybeans. Let's talk about gold. It's in many ways it's a great embodiment of this sort of the macro reflexivity of the commodity markets. It's sort of its own animal in that regard. But just to set the stage, I was looking at price action in gold. You read the headlines, but it's sometimes it's good to just pull up the picture, and what a tear. Since 2020, just going back 5 years, my interpretation, Greg, and you correct me, but it looked like it had a little run in COVID. I assume a little bit of flight to quality, flight to safety there. Gave all that up and then some over the course of 2022 with the Fed hiking. And really since 2024, it's been a rocket ship. And then this year, up 60% year to date. I pulled up Bitcoin just to check on it, up 17% year to date as of today's recording. So making the crypto guys look, risk averse or lower risk in contrast. And it's since mid-August. It's gone from parabolic to vertical in terms of its price action. So $4,200 this morning, at least last I looked. And just sort of setting us up. For lack of a more interesting question, what's going on, Greg?
Well, I think it's multiple facets that are driving this. When I think about gold, it really has a stool with many legs of support. You had, starting really in 2022, post the Russia invasion of Ukraine, and even leading up to it, with hindsight, if you were able to know what Russian central banks were doing, which was buying gold, as well as starving Europe of gas supplies ahead of the invasion, like to try to set up a better advantage system for themselves. When the Western world seized Russian assets, I think that really started a cascading situation where ultra high net worth individuals, but also central banks and sovereign wealth funds that were either opposed to the Western world order, as one could think about it, or were certainly in between the two, really started thinking about how do they balance their own security. And I think gold really started playing into the idea there. So you needed diversification benefits as well of gold, but really I think it had to do with being a protective asset for a number of countries.
And was this also? I think I've heard you talk about it in the past as a sort of a crystallizing moment for you, but the seizure of dollar-denominated assets, right? For not just for governments, but individuals as well.
Yeah, your chateau in southern France was no longer a useful asset, or the yacht that you had that was sunk or seized. I mean, it just was a different. I think the ability to hide wealth outside of some countries became much more challenging. So I think gold has created a bit more of a premium for the ultra high net worth individuals. But also, the other thing that happened in 2022 was the global inflation shock left countries that thought they would be relatively insulated really short inflation risk, really exposed to inflation risk. I'll be more specific. If you look at the 2000 to 2008 move where we had higher inflation than 2%, nothing like what we saw this decade, but we certainly saw inflation moving above 2.5%, 3% at times. That model included very strong economic growth. We were pushing on the supply chains for a lot of commodities. We saw inflation increasing, but the emerging market economies saw strengthening currencies, saw stronger economic activity, and as a result, were somewhat insulated. In this case, because it was much more of a supply-driven shock, they found themselves with weakening local currencies, no virtuous economic cycle, and had a very big sting from the global inflation spike that happened. So when a lot of these countries and investors, real money investors, were thinking about and looking at their exposures, they found themselves in a situation where they were much shorter real assets and much more exposed to inflation risk than before. So I think that has led to a change in which they're both thinking about gold and inflation risk in general and commodities as a result. So that's another part of the idea that real assets, whether it be a central bank or investor or real money, became a real need for a portfolio. And the last bit is just pure diversification. It's hard to just say that there is no questioning about the existing world order being sustainable, what the government institutions that we had set up, either multilateral or within countries like the United States that are seeing meaningful change, has led to a desire to have some diversification of assets in the mix. So maybe not just U.S. Treasuries or some other safe assets, but looking at historically millennium-old investment opportunities. So I think that's also benefited. So there's many things that are behind it. Now, locally, it seems extraordinarily rich. It's way outperformed what real yields, which you think is a powerful anchor for how to think about gold on a local basis. It's at the highest level in real terms we've seen, in the last 50 or 100 years. I think that says a lot about, maybe you could have a 10 or 15% retracement, but it wouldn't change the narrative at all. I think a lot of those buyers would just salivate at that opportunity.
It sounds like what you're saying is, there has been maybe a structural shift in demand for gold from whether it's central banks or actors who realized over the past decade that the global financial system may not be as safe for them, as they had thought it was prior to that, coupled with maybe more cyclical, maybe more structural, who knows, concern about fiscal policy or the traditionally stable trade relationships between major parts of the world. And so there's this safe haven element that's kicked in maybe a little bit more this year than in previous years. Is that a decent summarization?
Yeah, I think it's becoming fulfilling in part because of the momentum in the market. But I do think that actually that trend had started, and we've seen it in our own client base, well before this year. It
Right.
started a few years ago, and it's just sort of like spreading and becoming a little bit more prevalent. But I think it's becoming a little bit self-fulfilling because we've seen and observed the price moves. I mean, the fact that this decade gold has bested the S&P, which has a high concentration of the Mag 7, which is pretty high bar.
Yeah.
And it actually has been reasonably diversifying to S&P. The correlation is 0.1. It's pretty small. So I think from that standpoint, it garnered a lot of attention. But in terms of the diversification, we see international investors just have a huge exposure to the U.S. equity markets, have a huge exposure to U.S. rates. So I think the diversification that they're looking for in gold is notable.
Yeah, it's you had sent me an email. I don't know, maybe 6 weeks ago, because we were talking about having this conversation, and I think you asked me what are the two top performing assets this decade, and I went back to you sarcastically. I think I said Bitcoin and Taylor Swift. And when you look at the numbers on gold, it's just like there's nothing stands up to it.
Yeah, if we could have all been long Taylor Swift, I think that would have been
Yes,
a great diversifying
my daughter
investment as well.
would have appreciated that. She probably owns gold.
Which is very smart. Right,
Very
chip
smart.
off the old block.
Absolutely, that's good. That's a very good point. Her father being a financial advisor. All right, we shouldn't digress too much into Taylor Swift, much as we'd enjoy that. Brady, you got to get in on this. One, you're probably closer in age to most Swifties than Greg and I are. But
Probably fair.
Are you hearing about gold from the FAs that you speak to, and what's the volume of those questions, and what's the and how long have you been talking about it at this point?
I think to your point, you can't turn on Bloomberg or CNBC without seeing a gold headline. So it's absolutely in conversations with every advisor, and their end clients are also asking these questions. And I think as it relates to commodities, some of the trepidation, right? We've had good volatility in areas like gold, but you've had a really strong performance. You've had some allocations for a lot of financial advisors that were arguably underallocated to commodities in general in 2022. So you have a lot of investors thinking about investing, if not for the first time, then revisiting an allocation to commodities. And they're saying, hey, maybe am I too late to the trade looking at gold, with the recent performance that you highlighted. So I think it'd be interesting, Greg, if maybe you want to highlight some of the historical volatility of the asset class, that's definitely some cause for trepidation for some advisors considering allocation, but also too, kind of where do we go from here in terms of commodity performance and more generally?
Well, let's stick with gold because Brady, I think you're asking the question that I wanted to ask on where do we go from here? Because Greg, you kind of alluded to having a valuation model for gold, or at least some form of guideline, and that's the question I want to ask is if an advisor sort of came to you and asked $4,200, is gold cheap or expensive? How do you answer that question?
It's a question I'm very, very cautious in trying to respond to, because kind of like Bitcoin in a way, where there's a lot of different frameworks. People are just talking about the cost of energy to produce the marginal coin, and the computing power that required. It produces one result. There's other results that could come out. A lot of where the most bullish sentiment comes from is if you start looking at like increases in share of investor portfolios and or central bank holdings. The amount of dollars that would flow in would be meaningful relative to the size of the overall market, and as a result, could see prices move to levels 5,000, 6,000. I mean, the numbers that you can produce out of that is very lofty.
So that's extrapolating. Like if central banks get to 5%, the numbers are huge.
Yeah, would it be a lot larger because the central banks in the emerging markets are at that level or slightly lower and moving higher, but developed markets are in the mid to high teens. Yeah. So if you start just doing the math, like if the emerging market looks like developed market, like there's no gold. Like the difference also between gold and other commodities is that at the end of the day, almost all the gold we produce is on the surface of the earth. Like maybe there's some buried in with mummies and tombs, and there's the teeth that went were buried as well. But like for the most part, or some sunken ships with great coins out there waiting to be found. Yeah. Which I always love those stories. But at the end of the day,
by the way, quite an incentive to go look for some sunken ships these days at $4,200 an ounce, right?
It's not just sport; it's now profit, which is great. The best combination possible. Looks like college football now. But so when I think about how do you come up with a framework, it's very challenging because again, you're basing it on flows. Like higher prices only create more supply through either someone selling their investment, maybe some increase in scrap supply. If you go to 47th Street in New York City, like there's a lot of people standing on the street right now trying to buy your gold from you. Yep. Because of your holdings of gold, whether it be in jewelry, which was at one point fabrication was a larger share of the cost. Now it's actually the value of the gold that's makes it so that you can sell it for what you bought it for, if not more. So I think that's it though. But like new mine and incremental mine supply is slow to develop, and over a very long time, given how hard it is to develop mine and mine supply. So I think that makes it very challenging. That said, ultimately, it's a non-revenue generating asset. If you can get attractive returns and real yields in the order of 170 to 200 basis points, or nominal bonds, good nominal bond portfolio, 6-7%, which sounds small relative to the 40-50% return you've had in gold this year. But usually those environments make it harder for gold to go up because the opportunity cost goes higher. Right. So our framework usually is like, well, it's a real asset. How well do other real assets return? Well, that should be less attractive for gold right now. So that's why I'm saying locally, we think it's overvalued, but the flows have been substantial. The one thing that you said before, though, about vol in gold, the vol in gold is usually like 12 to 15%, which is not as high as equities. And certainly single stock equities can be, meaningfully higher than that. And if anything, it's actually, fairly, even with this move we've had now, like the realized vol has been, call it 17, 18%, very much in line with equities. So it seems scary because and people focus on the higher vol in part because it's a little bit outside of the normal investing focus. But in the grand scheme of things, commodity indices overall or gold are not very different. Like if you look since before COVID till today, it's roughly all the same. So, but the diversification benefits are compelling.
One of the things that I would imagine advisors grapple with right now, Brady, you can confirm or not, and Greg, you might have an answer on this, but I think despite obviously clearly people are buying gold and bullish gold, but the paradoxical situation we find ourselves in where you think of gold as store of value, and you think of gold as competing with cash, or competing with fixed income instruments, given what you just said, Greg, and you've got real good yield available in the bond market, which makes it more expensive to hold something that isn't yielding anything at all. Or you think about it as a safe haven in turbulent times, and it's like, a safe haven from what? Everything's working this year. Show me the asset class, and we'll get into energy in a second. But it's hard for me to parse the fear inherent in rallying gold prices with equity prices that are nearing or at all-time highs and all-time high valuations. Credit spreads are as tight as we've seen them. How do you in the halls of PIMCO, how do we break that down and try to come up with an explanation for how those things could be happening at the same time?
Brady, do you want to go first, or would you like me to give a...
Yeah, absolutely. Go for it.
Okay, so part of it is, like, when we think about the global liquidity, right? I think can partly explain where you're seeing both improvement in asset classes across the universe.
Sure.
So some of that money is going to be moving obviously into equities and extending the duration in fixed income and looking to buy interesting opportunities there as well. So I think gold is just part of that beneficiary. So that kind of puts it, when you start talking about the debasement trade that a lot we're focused on, it's hard to see for the reasons you just said. Like, if we're really worried about the fiscal balances in the U.S., like the 10 years, 50, 60 basis points below where it was, not that long ago this year. So, it is harder to see the case for, the debasement idea. But that doesn't change the fact that for the reasons I said before, there's just a desire to deploy capital in diversifying assets, in real assets. We're seeing it across our business suite. And as a result, without a natural supply response that's meaningful, the gold can perform quite well.
Yeah. Some dollar rotation, some cash being put to work. If it is cash being put to work, I guess it does raise a little bit of the specter, and sometimes we think about Bitcoin in this regard as well too. It's like, is it a risk-off trade or is it a risk-on trade? And so some of these correlations in the future, I would imagine, may not behave right if it is liquidity pursuing risk-on and chasing a rallying commodity. When times do become more turbulent, when we do encounter economic distress, may not see the kind of price performance from these traditional, I shouldn't say traditional with regard to Bitcoin, but certainly with gold, this safe haven, destination might see a totally different outcome.
So when I look at Bitcoin, it's very hard. Is it a real asset? I mean, we don't have enough history. It's much more complicated to answer that question. In gold, we have definitely seen, like in 2008, and people will not forget that moment where deleveraging across all portfolios led to a sell-off in gold.
Yeah.
However, extend the horizon just a little bit, and gold responded. It recovered back. And you can say the same in a few other episodes that we had, like in 2020 initially, like where gold sold off, and then, when it was obvious that there was going to be a meaningful fiscal stimulus as well as monetary stimulus, gold accelerated. So I think in small windows of time, it's pretty easy to say, like, oh, this is not going to insulate my entire portfolio. I mean, there's no doubt. I mean, the volatility in every asset class would make that hard to say with any certainty. But when you start looking at the fullness of time, you end up seeing the benefits. So like you could take this decade, for example, commodities broadly or gold, typically you would expect them to perform really well when inflation's above the central bank targets. And they're some of the best performing asset classes, and they were diversifying.
Mm-hmm.
That didn't mean that they did great from second half of 2022 to mid 2023. There was definitely a period of weakness, but in many respects, it's consistent with what your textbook expectations would have been prior to it, where you would have a situation that you would expect real assets to be a meaningful contributor both to returns, but also meaningfully diversifying. And all it took was inflation just being above the targets. It didn't require just high inflation and uncontrolled inflation. You see the real benefit. So I think while you can't get the day-to-day right or month-to-month, period, like for investors who do think about portfolio construction over extended periods of time, it was very consistent with what one would have hoped real assets would do. Liquid real assets. If you have office buildings that are like behind you right now, looking out the window, I'm not sure. Yeah. The podcast listeners can't hear it, but I'm seeing it right now. Like that wasn't so protective, but liquid real assets did perform.
That there's a lot to unpack in there. I think we obviously want to ask you your views on inflation protection in a two-legged individual's portfolio, right? Us human beings who are charged with managing money on behalf of our clients, our families, to prepare for later in life and retirement and all that. How do you raised the topic, so let's go into it. How do you think about using commodities or any other instrument to insulate portfolios against inflation, and what's the framework you would advise advisors to adopt and communicate to their clients?
When you were saying two-leg, I thought you were talking about like a 60-40 portfolio. I didn't realize you meant
No. It's we use it to differentiate, like the central bank investor with the limitless time horizon or the monetary policy goals from those of us walking around.
Okay.
Yeah.
I got you. Yeah. So when I start thinking about what is my risk personally, because I'm a two-legged individual.
Yes, you are.
Not a central bank. And I think about what is my concern about meeting my retirement goals? Well, one is inflation eating away at my asset base and my spending power, right? So if I look over the last 50 or 100 years as like examples for where we look at the benefits of having diversification, it is clear that when inflation is 2% plus, it doesn't even have to be 5%, like just above. An optimized portfolio would include a pretty hefty allocation to commodities and or real assets. When I say like it could be as high as 25, 30%, and sort of, you're looking back in the mirror when you're looking back. That is probably pretty high for most, investors thinking about them. But I don't think a 3 to 6% allocation is like unreasonable. And you can almost argue that as you get closer to retirement, you may want more simply to protect your purchasing power because your time for your assets to recover start shrinking when you need them, for meeting your life's goals. So it's always complicated when you're moving further away from your traditional investing of the 60-40 portfolio. But history has repeatedly shown that if inflation is a concern, which is a concern for retirees and savers, it's important to have the ability to protect that spending power.
Brady, do you think financial advisors, by and large, are thinking kind of mid-single digits, higher, lower? Where do you think the average advisor falls out on this?
Yeah. So for those who are making an allocation to commodities, typically between 1% to 7%. I haven't seen it too much beyond that 6 or 7%, right? And talking to a financial advisor yesterday, he says, "Hey, I have a commodities line item because gold is in the news, and my clients are asking me, hey, do I have exposure there, right?" So there is an amount of advisors who have a structural allocation, but again, there is a bit of trepidation based on we already touched on the volatility, and also I think what's can be a concern is maybe an investor or an advisor has a view on gold, on energy, less so likely that they're going to have a view on corn futures, for example. So, Greg, I know the audience would be really interested in hearing, how do you think about making an allocation? Should they buy a broad basket of commodities? How would you think about that from an overall diversification within a broader portfolio?
I tend to think that you could see a combination of both. If you take our multi-asset inflation index, for example, we have a gold sleeve, 10%, commodity sleeve, 20%. And we do think that there's benefits to having both. Given this latest move in gold, we think is the best way to approach investing in commodities, because we do think that there's a lot of supply side constraints through underinvestment that's emerging. Corn, as you mentioned, specifically is going to be a function of weather and growing. We've had a couple of decent years of good weather conditions, so corn prices are down, which is great for the global economy, for the global South, who, food is a larger share of their spending requirements than maybe the average American would be. But in general, when you start looking at metals, and Greg mentioned and teased early on about AI, the thing about investing in whether it be military industrial complex, whether it be the energy transition or now AI, it's massively commodity intensive. And while one could argue that productivity will increase, and ultimately as we invest in new energy, we'll be able to have lower marginal prices, the process of getting there is very commodity and energy intensive, whether it be in metals or whether it be the energy requirement to accomplish this. So I do think having a broad commodity investing is actually pretty appropriate for investors to have right now. Now, the one other thing I want to note real quickly about investing in commodities, it's fully collateralized. So for $100 investing in commodities, you get $100 of T-bills in the way in which the indices are calculated. Now, PIMCO, that's anathema to not invest that cash at something better than T-bills or try to outperform. But my point is that if you're looking at even rates at like 3.5% or 4%, commodity investing right now gets that general benefit when the markets, when you're looking at your portfolio. So I think the attractiveness of the space is appealing, and again, the diversification benefits are compelling.
So what do you in the U.S. at least then? Let's switch to the AI, transition, and energy markets haven't kept pace, with what we've been talking about, gold and Bitcoin and some of these, more macro sensitive commodities. What are you expecting in the years ahead in terms of kind of the effect of AI on your area of investment, and where should advisors be kind of looking for things that might have some of that micro strength that you were just referencing?
So energy broadly has been weighed down by the fact that OPEC in particular, but also some benefits from prior large-scale investments that have come to fruition, where we're seeing a pretty meaningful oil production cycle right now. Mm-hmm. That is going to be turning in the next 18 months to 2 years, in part because the big projects are coming off. There's also a variety of meaningful risks, whether it be reports yesterday about the U.S. potentially taking action within Venezuela, which I have no public comment on because I still don't understand exactly what's happening.
Right.
But you also have growing sanction and extraterritorial sanctions being applied by not only the U.S. but potentially Europe on lifters of Russian oil, as well as the snapback of sanctions on Iran. So there are some things that could change the supply scenario, and if that's the case, oil would recover pretty meaningfully here. But I think that's been the main reason why you've seen oil prices underperform others. And but a diversified commodity index is still doing great because we have that diversification. Natural gas is always a little bit unique in the sense that it's also a very weather sensitive commodity. The summer was not particularly positive. But if you look at the back end of the power curves, and if you look at retail power prices, in part because of the allocation of costs that need to be borne by someone, mm-hmm. and you can see the political challenges of that right now about who pays for the infrastructure to support the power. If you live in one state that's connected to the power market, another state that's now seeing meaningful load growth because of AI and data center investments, but you don't get any economic benefits in your state, are we going to still have well-functioning power markets? I mean, these are real questions that this growth is challenging. So while it hasn't driven returns,
I just want to I want to understand that. So a state that is AI friendly, that is permitting and allowing people to build massive data centers, is drawing power from the grid, raising prices for everybody, and the state next to them, maybe for any number of potentially good reasons is not allowed the hyperscalers in to build massive data centers. All of a sudden, it's sort of an unequal pros and cons distribution across those two states.
This is a real political problem evolving. And by the way, the example I was talking about was like, if you look at Virginia, it's in part because some of the earliest and large-scale investors was actually the U.S. government, the U.S. military, and so forth. So it's not like they were just way more friendly. They just had a load pocket that was early action.
Right.
All of a sudden, all the neighboring states that are part of a joint operating market for power is like lagging behind in the building of these data centers, but are realizing the tensions in the investments that need to happen to support load growth throughout the whole system. But you're going to have this as a real challenge because who's going to bear the costs? And costs are obviously, after the last inflation cycle, really front and foremost in the political discussions. So there's a lot of tension in meeting the future demand. Like, are we going to build more nuclear plants finally? And if so, how are we going to do it in a way in which is cost effective and timely, right? Because if you're trying to build a nuclear plant, other than the restart ones we're looking at, it's still a very extended timeline. So it's not going to solve 4 or 5 years from now load growth. So that's where I think the excitement about power markets, or where you've seen some of the way in which AI has come into play. But that's like, again, pricing something further down the future because we're building it right now. We're not quite using it as much as we will be.
I saw, it may have even been in our own forum, but I saw a chart of power usage in the U.S. where it's this flat, kind of tiny little bumpy line for forever, right? And it explained as kind of power usage has been we all use more electricity in our daily lives, and more of us use electricity in our daily lives, but now I've got LED light bulbs. And and our batteries have become more efficient, and every aspect of our lives has become more efficient. And so, the even as more of us use more electricity, the power consumption or power generation has stayed kind of relatively constant. And then I saw the projection was with AI, with my daughters, making videos of puppies on the beach, costing, 50,000 times as much as, a typical Google search, like that number could be jumping, 10, 20, 30, 40%. And that, do you see that kind of ramp from here, or are you a little bit more skeptical of where we could go in terms of power consumption?
So part of the power consumption could be simply limiting what we can do. Like, it's possible you just have this sheer supply constraint. But I do want to digress for 1 second and say we should close any video recording of this with that puppy video on the beach. I think our clients would love that. But if you look at the U.S., there's no doubt that we're going from 25 basis point growth for the last 15 years to something probably north of 1.5%. Now, the one area where I would caution is that we often in markets, commodity markets in particular, when there is a wall we are worried about, we tend to figure out ways to avoid hitting it. Lithium was a prime example. Everyone was super excited about electric vehicle demand growth and battery storage demand growth, and prices went through the roof, and then we adjusted our demand, and then we created a new supply. Similar here, so if you're looking at chips, like there's going to be a big premium for energy efficiency. There's also going to be a lot of management of load that you could do. So it doesn't mean I'm bearish it. I'm just saying, like, some of the frothy forecasts may end up being tough to realize. Mm-hmm. But the tailwinds, though, are clearly in the direction of travel. All right, and you're going to see meaningful additions in power demand. You're going to see meaningful additions in materials required to build the data centers, to build the chips, to build the grid to support it. And it's that train has left the station and is gathering steam. But again, if you give me a 10-year horizon and say, is it 1.5, 1.25, or is it 2.25? Like, it could be any number of those.
Yeah.
But I think the NVIDIA CEO was on a Columbia University podcast with Jason Bordoff not that long ago, and he was talking about the efficiency and energy improvement in the chips that they've done over time, and it's notable. I mean, it's really remarkable the amount that they've managed to improve it. So, again, technology is a race, and I think you could see some of the energy efficiency creeping in faster than what the current assumptions are.
It's fascinating stuff, and I think, in this latter part of the conversation, seeing in some of these other commodity markets, energy, power, a little bit, some of the same macro qualities as gold in terms of inflation hedging and that sort of diversifying role in the portfolio. Maybe what I'm hearing from you, Greg, is a stronger micro case for price action in those commodities relative to gold. Not that you made a prediction about one or the other outperforming, but at least some more intrinsic fundamental drivers of usage coming up in some of those areas. I think this is all great. I think we've laid a great groundwork here for future podcasts where we can revisit this conversation and talk about these issues. I don't think they're going to be leaving us anytime soon. Greg, thanks for all the time this morning. Really appreciate you joining us. Like I mentioned, we'll do this again. You've earned your way back, and we'll revisit these topics and themes. Brady, thanks for coming in from Wyoming, Montana, or Idaho, wherever you last were. And just as a reminder to all of you listening, Accrued Interest is part of our Advisor Forum platform. Advisor Forum is your destination at PIMCO for all things designed to help you serve your clients, to do so pragmatically, efficiently, and give them the best advice that you can give them. If you visit us at PIMCO.com and identify yourself as a financial advisor, you'll be taken straight to Advisor Forum, where we've curated a selection of thought leadership and tools that you can use on behalf of your clients to make better decisions. If you enjoyed today's podcast, or if you enjoyed previous podcasts, feel free to like and subscribe. Knowing how many of you are out there helps us tailor our programming and do a better job serving you. Until next time, thanks so much, and we'll talk to you soon.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures.